Hi, we're David and Debbie Bennett with Financiers Mortgage Group in Fort Worth, Texas.
And we've been the mortgage approval experts since 1984.
Now, how we became the approval experts was by taking care of all those little mortgage details that trip so many other lenders up. This week we'll be talking about all the little things you need to know to be able to fill out and document a loan application so that it truly becomes a roadmap to success.
This video is a training film and a step-by-step tutorial all rolled into one. We'll show you why a properly filled out and documented mortgage loan application is the most important part of the mortgage process.
Now, it doesn't matter if you're applying for a $50,000 loan or a $2 million loan. The basics are the same. The loan application is the mortgage world equivalent of the sales contract. Now, we'll be giving you a glimpse at some of the behind-the-scenes thought processes and underwriting standards. And since we're talking about a roadmap to success, let's talk about something as simple as a real-world roadmap. If you were in the Fort Worth, Dallas area and you headed out west for a much-needed vacation to Disney World, you'd be heading in the wrong direction.
I'll give you a hint. It's in Florida, not California.
In the same fashion, we don't want an underwriter to accidentally head off in the wrong direction on your loan.
Hopefully, if you headed towards California, you'd soon find out you were headed in the wrong direction and follow the map on your iPhone to get back on track to Florida.
But underwriters don't have a smartphone or Google Maps to help them arrive at the right conclusion on your loan. It's up to you and I to give them a very clear map of the direction we want them to go and the nice thoughts we want them to think. In other words, you and I are the iPhones of the underwriting world.
As you'll soon find out, there's a whole lot more to filling out a mortgage loan application than just filling in a few blanks.
There's a lot of strategy involved, and that's where we come in. We've been doing this for almost 40 years, so we have more than a little insight into the best ways to present your case.
We've done it so long, we can do it in our sleep.
As one of our realtors says, you guys, wait a second. I think it'd be much more effective if you hear her say it.
You guys are like artists. I tell my people, if you will do what they say, they will get you a loan.
The mortgage application is your life story, and who knows better how to tell it than you?
We know loan program guidelines and what information is important to an underwriter.
You know your personal facts.
Together, we can assemble the data so it makes a compelling case for your loan approval.
We found that if we can educate you to the wants and needs of an underwriter and explain loan guidelines, then you'll know how best to help us.
In other words, we'll tell you the why so that you can tell us the hows.
Even if you've bought many homes or been in the business for a long time, you'll learn a lot from this training video. Mortgages have become very complex beasts,
Oh, have they?
and many more of the little things can trigger major issues than in the past.
So pause the video and click on the link beside it to download 3 things: a loan application, the page entitled Info Needed at Loan Application, and the 10 Commandments of Applying for a Home Loan. Then we'll step you through the application section by section.
I guarantee you'll learn something and better your odds at a loan approval.
It's true. The mortgage application is the roadmap that everyone from the appraiser and underwriter to the title company follows. How it's filled out determines to a great degree how problematic or how simple your loan process is, and ultimately whether your loan will be approved.
Just as there's a right way and a wrong way to write a sales contract, filling out the loan application incorrectly can lead to severe, unintended consequences.
Don't get the wrong impression we're talking about lying or making up things on a loan application. We're not. No, we're talking more about a well thought out series of supporting documentation to emphasize your strengths, de-emphasize your weaknesses, and point out your compensating factors.
The sad fact is that all underwriters have their own prejudices. As loan officers, we have to work very hard to be sure their prejudices don't have a chance to take root.
We'll always prepare for a great big old grizzly bear of an underwriter, chock full of prejudices about your situation, and pray we get a pussycat. Presentation is the most important job a lender does. And your loan application gives us the ammunition we need to be able to write a Pulitzer Prize winning cover letter and gather the supporting documentation needed.
Let us stop right here and say there are app takers and there are loan officers.
If the person who takes your loan application doesn't counsel you about almost every line item and hands you and your information off to someone,
or several someones to complete the process,
people who have never talked to you and have no clue of the intricacies of your situation, and then the loan officer, app taker, doesn't stay involved throughout the whole process,
or even come to closing with you,
then they're only app takers, and you don't have nearly as good a chance of getting your loan approved.
As we said before, presentation is the most important job a loan officer has. Your loan application is a story.
A story about you and how you not only have the capacity to repay this very large loan, but also a story that shows your willingness, sometimes under extreme duress, to do the right thing all the time.
We'll keep this video simple, but it will definitely not be just a primer. Unfortunately, there's simply, like what I did there, no way we can cover every possible situation. We'll cover about 95% of the situations, but if we don't cover your exact situation, please give us a call. It may surprise you, but at Financiers, we begin the application process by either taking a picture of the whole family or asking for one.
We don't want a goofy picture. We want one that makes you look trustworthy. Casual is much better than pose, so we don't want an Olin Mills portrait either. Why do we want a picture, you ask? There's no place for a picture on the loan app. Remember we said presentation is the most important skill of a loan officer. It's all part of our master plan. I think I've been watching too much Pinky and the Brain. Anyway, we want your picture to be the very first thing the underwriter sees when she opens your file. We're working very hard to make the underwriter see this massive pile of papers as people, not just more paperwork. They can have empathy for people, but not for papers. Your picture will be on a cover letter that gives the underwriter background information that's outside the loan application and gives the underwriter a roadmap of where we want them to go.
We'll use this opportunity to explain away any weaknesses.
Don't worry, everybody has them.
By offsetting them with positive compensating factors before the underwriter ever begins looking through your file and developing opinions. So the first thing I want to tell you is that it's easy for us to have too little information and tough to have too much.
That's right. Now the first big surprise you'll encounter is how little time it'll take you to fill out your portion of the initial loan application.
Most people will just have to furnish us with a 2-year address and job history.
We'll need 2 months bank statements to prove you have enough money to close.
We'll prove up your present income with a month's worth of pay stubs along with 2 years W-2s or 1099s and tax returns.
We'll develop the rest. You probably can complete the preliminary loan application in 5 minutes or less. And don't worry, at this stage there will be large portions of the loan application left empty.
From the info you give us, plus what we develop from the credit report, bank statements, and appraisal, we'll complete the official loan application, and this will become the basis for your loan.
Now before we go any further, you need to know that a computer doesn't approve your loan. A human does, and that's why we're playing up to the human component so much. The computer is involved.
And how you fill out the loan application
and the credit report determines the amount of information the computer will require of you. The computer tells us how far back and to what detail we need to verify your data.
It tells us what documentation we'll need, what type of appraisal, and a few other things like that. But the computer does not approve a mortgage loan.
It only recommends that a human being look favorably upon you if everything matches the initial loan application exactly. It never does. And the human sees no red flags in the documentation provided.
Red flags like strange deposits or income.
You should be glad too, because if the computer did the approving, Probably 60% or more of the people would be turned down because a computer can't listen to your story.
Now follow along using the loan application you downloaded from our webpage, pausing where you need to fill out your own loan application. The loan application is usually 4 pages long, but it could be longer if you have a great number of debts or a lot of different asset accounts. Now at the top of the very first section of the very first page is a paragraph that most people miss that simply asks if you'll be applying for a loan either by yourself or with a co-borrower. If you check the first box, it means you'll have a co-borrower. If you check the second, it means you're going in alone. Then all parties to the loan will need to sign. Now, unless your loan application is for a refinance, the next 2 sections labeled 1, type of mortgage and terms of loan, and number 2, property information and purpose of loan, you will leave blank and we'll fill them in later from the contract terms and the appraisal. If you're doing a refinance, we'll get this information from your old closing papers and the new appraisal. Now, we can afford no mistakes in this section, which is why we get the information only from confirmed sources. We'll need a signed copy of your sales contract. We can work off an unsigned copy, but we'll need a completed contract before we can get your loan approved. Heck, under the Dodd-Frank Act, we need it before we can have an official loan application. But that doesn't mean there's not work we can do before that time. And speaking of the contract, we'll also need a copy of the canceled earnest money check to prove you actually paid your earnest money. Your earnest money will be applied towards your down payment and closing costs if you furnish us with proof the money actually changed hands. Nothing you'll pay in advance of closing, except for possibly the home inspection, is extra money. It's all part of the closing cost figures we'll give you later. There's a small amount of money needed prior to closing. Someone will need to pay for the credit report and appraisal, which will also be applied towards your closing costs. Now, depending upon how the contract is written, the seller may be paying for the appraisal. I know it gets a little confusing when we talk about closing costs, but the government says that any monies you spend to get into the house are closing costs, even if they don't come at the time of closing. Now, Section 3, labeled Borrower Information, is the easy part. Just don't leave any blanks. We'll need for you to give us all your personal information, including email addresses and cell phone numbers for all parties to the loan. Marital status and number of children can affect how we address issues, so we need that information too. VA even qualifies you based upon the number of people in the household. If you have a child that's living with an ex, this would be the time to tell us about it. We also need to know if you pay or receive any child support. This could trigger the need for a copy of your divorce decree. We'll also need at least a 2-year address history with no gaps. An underwriter will be looking to see how stable you are. Now, their idea of stable is no more than 2 addresses in a 2-year period. We'll need contact information for every landlord you've had in that 2-year period. If you're buying your present home, then that information should be on the credit report. We can use 12 months canceled checks instead of verifying the information through your landlord. Now, the nice thing about using canceled checks is that this is under your control, whereas if you have to send out a verification of rent, we're at the mercy of your landlords, which can sometimes delay things. Now, here's something to think about on your address history. Temporarily living with family can become a negative. That is, unless it allows you to save much more money than normal. Long-term living with your family doesn't give an underwriter an indication of whether you actually can pay your house payments and all your bills. Now, a rough rule of thumb is that the smaller the increase between your old payment and the new payment, the more favorably they'll look at you. The greater the difference, the bigger the magnifying glass they'll pull out. Living with family usually means you're paying $0 of provable rent, so you have the highest payment increase possible, which means the underwriter must scrutinize your loan more thoroughly than if you're living somewhere with a provable rent history. So, if you're going to live with your folks while you save money, they need to be paying them a regular rent check, not a money order or cash, instead of paying for groceries or paying for some of the utilities. We want to be able to show you have the capacity to pay a monthly housing bill and pay all your bills and save money. Now look at it logically. If you can't pay your older, lower house payment, then how in the world will you be able to pay the newer, more expensive house payment?
The loan app only requires we go back 2 years, but nothing says we have to stop there.
Many times we've gone back as much as 8 to 10 years in places just to prove our point. Apparently, our methodology works too, because we had a turndown rate of 1/10 the national norm in 2011.
Section 4 is your employment information. In this post-Obama age, this area is the most complicated and crucial section of the whole loan application, so we're going to spend a little time here. This section is only simple if you're paid a straight salary with zero extras and you qualify for more home than you're buying. We'll need to talk about all the many different ways to document the different types of income. So, to make it easy for you and allow you to fast forward over the income types that don't apply to you, I'll clearly label the video with each income type. Although I will say that learning what underwriters think about each different situation might help you know better how to present your case to an underwriter. Detailed information is on the Info Needed at Loan Application flyer you downloaded from our webpage. Unfortunately, because things have gotten so complicated and time-consuming, many lenders no longer will bother to help you work out all of your options. But here at Fine & Sears, we'll take whatever time and effort it takes to prove up your maximum income. It's one of the main reasons our approval rate is so high. Now understand that in this video I'll be giving you the official guidelines, but with proper documentation, many of these guidelines can be moved around a bit in the sand. So if we tell you something you don't want to hear, just call us. Many times when you hear your whole story, it changes things. In this section we will need to see a 2-year work history with no gaps, along with contact information for every job. Now, an underwriter's idea of stable is no more than 2 jobs in a 2-year period. They're looking for stability in job history as well as looking at the stability of your income stream. We'll always need your most current 30 days of computer-generated pay stubs showing year-to-date info and copies of 2 years W-2s or 1099s. Please copy them one to a page and not all copied on the same page. You don't get computer-generated pay stubs? Just call us for alternative documentation. Here's another new issue. To confirm your income and to combat fraud, the Dodd-Frank Act now requires all lenders to pull your tax returns directly from IRS on 100% of all loan applications. If your tax return shows a different income than you've claimed here or what your pay stubs show, we have to document the difference. For instance, if you were to show a loss or a gain on a rental property, or if someone in your family also has a side business where a paperwork loss or gain is reported, that's something we've got to document, and any losses are subtracted from your income. This means that even if you're paid by straight salary, we still need to see a copy of your tax return very early on in our relationship to see how to help you fill out your loan application. We will also need a copy of every pay stub you receive from the day of loan application until the day you close. While your pay stubs will prove up some sort of income stream, we may need to be able to contact your boss or HR to get some clarification of income. Plus, one of the many new rules says your employer must be contacted just prior to closing to confirm you haven't quit your job or been fired. So we need a direct line phone number.
Now let's talk about all the different types of income streams. For hourly and salaried people, we can definitely count as consistent income whatever your company will confirm as your minimum work week or your base salary. Anything else might need to be documented as bonus or overtime.
For commission people, we need to see complete tax returns for the last 2 years. We will be looking to establish the regularity of your income stream. If you have high enough credit scores plus have good money and stability factors, we might get to use just 1 year's tax return. Your specific situation will determine exactly what is needed.
Keep in mind that underwriters will be looking for an income stream. They won't look at or count isolated events as income. This means that typically they'll look more favorably on minimum income figures rather than the maximums. A 2-year average is the preferred figure to use, but with the proper documentation and cover letter, many times we can get away with a lot less.
If self-employed, please furnish complete personal tax returns for the last 2 years and corporate returns if you own 25% or more of the company. Depending upon your situation, they may sometimes want a current P&L statement and balance statement prepared by an accountant.
As a general rule of thumb, only the adjusted gross income, which is line 31 of your tax return, it's at the bottom of the first page, will count towards income qualifications. We do get to add back any write-offs that were not actually out-of-pocket expenses or one-time expenses such as depreciation and or some large purchases. If you have high enough credit scores and have good money and stability factors, we might get away with using only 1 year's tax returns. But you must have filed at least one tax return before we count any self-employment income. Your specific situation will determine exactly what is needed.
Church people and other people where all or a portion of your income is non-taxable income, you get a break. Since underwriting guidelines presume any income figures we use will have taxes pulled out of them, and since yours won't, we get to gross up your non-taxable income to show what the gross figure would have been had you been paid in taxable income. This means you might qualify for a larger loan than you think. For some reason, this seems to confuse most lenders. We get it. And church people are a good portion of our business.
For people with bonus or overtime income, your bonus or overtime income figures must be averaged to show what cash you should have available most of the time to make your house payment. So unless your company will report a very definite bonus or overtime figure for future income, or prove that your bonus and overtime income numbers have been changed and will guarantee your income will continue at the new higher rate, we will probably have to average. Now remember, underwriters are looking for consistency since your house payment will be very consistent. For a bonus to qualify as income, the manual says the bonus cannot be based upon performance or company profits. Both bonus and overtime income must be stable and recurring to count as qualifying income. The ideal bonus will be paid monthly, have a history, and be guaranteed. But with proper documentation and a good storyline, even a less than ideal bonus and overtime income might be able to be counted.
If you have a second or part-time job, due to the fact that second or part-time jobs are not the norm, the underwriter will want you to have a minimum of 1 year on the part-time job, plus have a history of working a second or part-time job before we'll be allowed to count it. Even with this history, they may still want to count only a percentage of your part-time income. Look at it from their perspective. The house payment will go on for 30 years, but will your part-time job? Fortunately, if we paint the picture right, even if they don't count a penny of your income, your second or part-time job can make for a great compensating factor and allow an underwriter to extend a ratio elsewhere or overlook another weakness, which sometimes is better than counting it as income.
If you have additional income of any sort, we'll need proof of that additional income along with the terms of its continuance. The underwriter will be looking for proof other income will last at least 3 years or more.
If you have interest or dividend income, the underwriter will need to see a 2-year average of that income from your 1040. Will any of this money be used for your down payment? If so, this income will need to be reduced.
If you have a rental income, the underwriter knows their expenses to owning a rental property. Therefore, to arrive at the net qualifying income, they will count only 75% of the income and subtract 100% of the cost. We might also need a copy of the lease. Let me give you an example. If you had a $1,000 monthly income, well, $1,000 times 75% equals $750. Let's say your house payment was $620, so $750 minus $620 equals $130 net rental income. Now, alternatively, you can furnish 2 years tax returns to prove up a higher income. Now, if you receive child support, you must be able to document it to count it. Documentation is usually canceled checks or court records. We need to be able to prove the support will continue for 3 years or more.
Notes receivable. To count note receivable income, we'll need a copy of the note evidencing a minimum of 3 years remaining and evidence the income has been received for the past 6 to 12 months. So as you can see, if you have any type of variable income,
and this includes hourly incomes,
you want to keep in mind that since your house payment won't vary, we will need to be able to prove that variable portions of your income with a greater degree of certainty than just a month's worth of pay stubs.
That's right. The manual states you must have a 2-year history of any inconsistent income before we can count it.
But now that's not always true.
This is the portion of the loan process that proves up the saying, it's tough to have too much information and easy to have too little. With the information that you furnish us, we may be able to prove up a larger income,
or prove there is enough consistency to satisfy an underwriter.
It takes a lot of work on our part to do this, but we're prepared to help. Unfortunately, most lenders no longer allot time for this type of work and will turn away or turn down people who have more difficult situations. But we figure it's just part of our commitment to secure you a mortgage.
Taking the time to carefully document someone's income is one area that gets us a lot of thanks from our customers.
It's also the reason most loans are transferred to us. People are always telling us other lenders haven't been willing to dig to prove up other incomes. I just had a buyer say the other day that if the builder's lender had 2 more brain cells, they'd have been a Brussels sprout.
We get a lot of loans approved that other lenders throw out.
In 2011, just over 50% of all of our closed loans had already been turned down by at least one other lender. And yet, we were able to get the buyer usually the same loan, same down payment, same interest rates. How?
Because we're willing to do the extra work other lenders aren't set up to do.
Section 5 is about your monthly income and combined housing expense. We've covered the income issues under the employment section, which should give you an idea of what numbers to enter here. So now let's look at housing expense. If there's little difference between your present house payment and the proposed new payment, then you're looked upon favorably by the underwriter. But if your house payment is going up a lot, say 1.5 to 2 times your old payment, then you'll need to be able to show the underwriter you've been able to live well at the old house payment and save lots of money. The less difference between your old house payment and your new one, the more favorably the underwriter will look upon your request for the new mortgage. So back to income for just a minute. They'll be looking for the consistent portion of your income that's available to pay the consistent house payment you're asking for. That means they'll want to exclude any non-consistent incomes like bonuses or commissions, etc., which means we'll have to work very hard to get them to count them. It's an uphill battle and not a given they can always be counted. This is one of those times where it's tough for us to have too much information. The easiest way is to be able to show you've gotten these incomes consistently over the past few years. As you might be realizing, consistency is a key word when it comes to income. Section 6 is assets and liabilities. We usually need 2 months worth of asset statements from all your depository institutions, and we need copies of all pages of the statements. If your statement says there are 8 pages, then we need all 8 pages, even if one of them is intentionally left blank. Just like the pay stubs, we'll also need copies of every depository statement you receive between loan application and closing.
There's one exception to this rule that applies to both pay stubs and bank statements, and that's a bill job. With a bill job, we'll be gathering data and processing your loan. Then we have to stop and twiddle our thumbs while your house is being built.
Later, we will have to rush and do everything all over again.
All the information you gave us up front will expire. So about 60 days prior to closing, we'll need to regather all your pay stubs, bank statements, and other data.
If you have any large non-payroll deposits, then they will need to be sourced.
Which simply means we have to show where the money came from and prove it's not a gift, loan, or drug money.
It's easy to do at the time of the deposit, but tough to develop later, so make copies of any large checks you deposit. We may not need it, but it's better to have it and not need it than need it and not have it.
That's so true. Now the underwriter will be looking for your ability to manage and accumulate your own money, which is why they'll be asking for documentation of any large non-payroll deposits.
Your down payment, closing cost, and reserve cash, which is typically 2 months' house payments, will need to be verified as being in your bank account prior to loan approval, not just in time to close. If you're saving money to close and all your funds cannot be verified by using your last month's statement, then we will either need to send a verification of deposit to your bank or get a computerized teller statement showing the funds are available and documenting how it got there. If any portion of the down payment or closing cost is a gift, then we will need to verify the gift, the funds transfer, and show the gifter had the capacity to give you the funds without wiping themselves out. Unfortunately, not all loan types allow you to get a gift.
Gifts are good and gifts are bad. They show you have a family that will support you, but they also prove beyond a shadow of a doubt you couldn't do it on your own. So if you must have a gift, it means you probably won't qualify for as large a loan, since the underwriter will have to lower the allowable debt-to-income ratio and/or tighten some other credit standards in other ways. A gift will definitely make an underwriter look more carefully at your inconsistent income, like overtime, commission, or bonus incomes. Well, so much for the incomes. We'll fill out your liability section with the information we get from the credit report. But you need to be aware that credit reports are 3 to 4 months out of date. This means that if you paid some debts off or down since the report was last updated, the simplest way to prove that is for you to give us your most current monthly statements.
Now, this is a very important portion of Section 6, but it's overlooked by many. We want to show your ability to accumulate wealth and manage your money. We want you to look as prosperous as we can to the underwriter. We don't want you to look like you're just barely scraping by. So estimate the replacement value of all your household goods and personal items. Now, a good starting place is $4,000 per room, or in other words, the cost to buy, not the garage sale value. Don't forget your closets, underneath the cabinets, and the garage. Insurance agents use 60% of the value of the house, and they're usually pretty close to right. If you have plenty of belongings, then the underwriter won't be worried about you having to buy a whole house full of new furniture, a lawnmower, etc., etc. We also need the make, model, and present value of all vehicles owned, including boats and motorcycles. Bring copies of titles if they're less than 3 years old and owned free and clear. Leased vehicles count as a debt, but not as an asset. We want to know the face amount in cash value, if any, of life insurance. Also the name, quantity, identification numbers, and cash value of all stocks and bonds. Statements on IRAs, KEOs, 401ks, as well as retirement funds, and the percentage estimates. Now, if applicable, we may need copies of bankruptcy papers. We may also need copies of divorce decrees if either party has had a divorce. This would show any contingent liabilities such as child support and hopefully eliminate problems arising from erroneous credit reports. If you only know real estate, it might be considered an asset or a liability depending on how you fill out this section. But we need to make sure this section matches your tax returns. Number 7 is the details of the transaction, and that's a section we're going to have to fill out. But we can't until we have a copy of the contract to know what the price, terms, loan conditions, and who will be paying the closing costs. Will it be you? Will it be the owner? Will it be us? We have to know this before we can fill this section out. Number 8 are the declarations, which simply are questions you'll need to answer for us. They ask you what seems to be 12 times you've had a foreclosure, or in foreclosure, or thinking about going to foreclosure. Strange thing is, this has been there since the 60s and isn't something that's been added in the last few years. Number 9 is the acknowledgement and agreement. It says you really want to apply for a mortgage, no one is twisting your arm, and you're holding everyone harmless if you don't get a loan. It also tells you that it's your right to receive a copy of the appraisal. We've always given people a copy, but apparently some other lenders weren't so diligent. We will forward a copy of the appraisal to you as soon as the appraiser emails it to us. Section 10 is the information for government monitoring purposes. It's where you give us the information that allows the government to monitor the loans to see the percentage of what sex, race, and ethnicity is getting a loan. If you don't fill this section in, we're required by law to fill it in based upon our best guess. I've never missed race, but I did miss sex once. Now that's embarrassing. This is also where you'll sign the application. Obviously the loan app can't be completed until a lot more data is added, then you'll be able to furnish us at our initial contact. The original will be deemed to be the pencil copy, and it's okay to have strikeouts and changes.
Here are 5 other requests we need to make of you.
Please pay all your bills in a timely manner. A late payment at this stage could cause your loan to be rejected.
Don't make any new loans or charge on your existing creditors. A new loan or an increased loan balance at this stage could cause your loan to be rejected or raise your interest rate. Retire your credit cards until after your home loan closes. If closing funds are tight, be especially careful of those 30-day accounts such as American Express. If you absolutely positively feel the need to make a large purchase, please talk to us beforehand.
Don't allow anyone to pull your credit. Credit pulls can lower your credit score by 8 to 10 points. for each credit pull, which can cause your interest rate to rise or even cause you not to qualify. Those no payments till next year loans give you a credit pull, plus they are reported to the credit bureau as active loans with payments. Therefore, they count as debts and affect your qualifying ability.
That's right. And please, don't go out and buy furniture. Don't even go shopping for furniture. Please, please, please. Many times we've seen people buy furniture or put it on layaway only to find out they no longer qualify for their new home with the additional debt. You'll have years and years to buy furniture after you're in the house. First the house, second the furniture.
And most of all, do not change jobs, even for a raise.
Correct.
A job change shows instability. Talk to us before you even consider a job change. It might be okay, but it also might be disastrous.
Usually it's disastrous. Well, as you can see, the mortgage loan application is basic to the whole loan process. But I don't think you believe that basic means simple anymore, do you? It's the most complex piece of the mortgage process, and it's literally the heart of the transaction. Buying the wrong home or paying the wrong price hurts once, but getting the wrong mortgage hurts every month for the next 30 years. So it's critical that you have a lender that's working for you and not just an app taker. Now, under present rules and regulations, it's impossible to have a significant difference in interest rates or closing costs between lenders. So the difference between lenders is the service and knowledge they bring to the table. Just try to get another lender to spend as much time educating and helping you as financiers. I don't think it can be done. We're not a 9 to 5, Monday through Friday type of company. We divert our office phones after hours to our cell phones, and we actually answer them after hours on weekends and holidays. So you can reach us when you have the questions and needs. We do all types of home loans from $45,000 to $2 million. We make the simple ones simpler and the tough ones easier. We don't think financing ought to get in the way of the fun of buying. And may I point out the obvious? Doesn't it stand to reason that if we know more than the other guys and are willing to do more than the other guys, wouldn't you also think we'd get more approved than the other guys? Now, I'm just saying. Until next time, this is David Bennett with Financiers Mortgage bidding you adieu.